This is Pre-Market Prep. I'm Brianna Valesky with my co-host Joel L. Kahn, and we're joined by Jack Litle. He's a Mercenary trader. He's got 17 plus years of experience in the markets. He focuses on a lot of global macro, so that's what we're going to get from him. Jack, thank you so much for joining us this morning.
Thanks for having me.
So obviously a lot of action happening in China. They devalued the yuan, and especially last night, Chinese stocks plummeted, and it's kind of had a ripple effect on European markets and even earlier this morning Wall Street futures. What's your take on this situation?
Well, the broad take is that if you think of this whole risky situation as a big pile of Jenga blocks, China could be pulling the key block from the pile, and that China's crisis could then trigger a crisis in emerging markets, which could then lead to a major short squeeze in the U.S. dollar, which destroys corporate U.S. earnings already hit by the dollar, and you're seeing this domino chain come into effect. So this could be the beginning of a very big risk-off sort of switch, which we're a little bit due for in the sense of heading towards the end of this cycle where we seem to have a crisis every 5 to 7 years, and this is the next one kind of showing up on schedule.
Do you think investors should be wary of Chinese stocks because of this?
I think they should be wary of the whole global economic financial system. Some have said not to worry about the Chinese stock market because it's such a small component of the Chinese economy, but the real problem is that people are becoming aware, one, that Beijing is losing control, the Chinese government is losing the plot, and two, the question is, what is China going to do to try and keep its economy from slowing down? They've already thrown $1 trillion at trying to prop up the stock market, and it hasn't worked. So the next question is, how hard are they going to keep devaluing the currency to try and get their exports up to save their economy? Because that's going to have a ripple effect on everyone else. So yes, they should be concerned about the Chinese stock market, but more because of the ripple effects it's going to have on everything else in all the other markets in the global economy.
What's going on in other emerging markets in the global economy right now?
Well, mainly they're getting hit very hard by China and by the commodity crash. China is by far the world's largest consumer of many key commodities, and so this economic slowdown is what's led to a sort of a slow motion crash in commodities, which is actually worse than 2008. You're seeing commodity prices right now fall harder than they did in the 2008 crisis. And of course, a lot of emerging markets supplying commodities was their main gig, and so they are really hurting. So that's, for example, why Brazil is deep in crisis right now and recently saw their debt downgraded to junk. And so you could sort of say China is catching cold, and a lot of emerging markets are feeling it. And emerging market stocks have broken down from a major sort of wedge that's been many years in the making. So it's looking a little scary there.
You mentioned the drop in commodity prices. What about crude oil? What are you watching in that?
Crude oil is very interesting in that we saw Saudi Arabia sort of start an oil war to punish U.S. shale companies, and that sort of began in late 2014. And now we're seeing that OPEC is losing control somewhat because basically Saudi Arabia opened the taps to try and kill off the shale boom, and what they're discovering is that U.S. shale producers are like cockroaches. They're very hard, if not impossible, to kill, and even if you kill the current crop in terms of making them go bankrupt, some other energy companies will just buy the assets and the oil will keep pumping. So we see the potential for the bottom to fall out of oil. We could see crude oil prices test $30 a barrel, and if that happens, that's going to be very, very interesting. People are going to start wondering what's going to happen with OPEC. Should they close up shop or what? And that's also going to have ramifications on the high-yield debt market because U.S. shale companies borrowed so much speculative capital for wells, and that's going to impact them negatively now if the price of crude keeps dropping. There's a lot of bottom pickers whose fingers are going to be burned as well in the energy space if crude continues to fall.
Are there any companies in particular that you can think of that would suffer, from high yield bonds defaulting on those if crude oil continues to plummet?
Well, sure. Well, it depends. The oil service companies have said they're hopeful for a bottom. The big oil service companies from Schlumberger and Halliburton on down, they said, oh, we think things are getting better. But really, that's predicated on the hope that that crude oil turns around and that their customers have seen a bottom. If the oil price just continues to fall, then you're going to reach a point where these shale companies, these frackers, a lot of them simply run out of time and room for loan extensions, and they just start going bankrupt. And then you get the revenues are hit for all the oil service companies, but the big guys too, even Schlumberger and Halliburton. And then people realize, wow, the bottom's not in, and you get a whole other leg of downtrend for oil service and energy stocks, which are already been hit pretty hard. I mean, if you look at XLE and FCG and some of those other ETFs, they're already sort of in major downtrends, but we could see the bottom fall out if this really comes to pass.
Some major investors have come out and said they think that there is a bubble in the high yield debt market. Would you agree with that?
I would say that what you saw was you saw a lot of reaching for yield over a period of many years. There was a point, I think, maybe 12 months ago when Merrill Lynch said, oh, to get your 10% returns, just buy junk bonds and put some leverage on them. So there was definitely just this attitude of completely throwing risk concerns out the window just to try and get a little bit of extra yield in a 0% world. And that's definitely going to come back to haunt these guys, as we also saw sort of, again, in the shale space, we saw a buildup of no covenant loans and all these risky loans being taken out without the normal restrictions and precautions. So there was definitely excess, and the piper's going to be paid, it looks like, fairly soon here.
Are you looking at any other bubbles in the market right now? I know you mentioned unicorn bubbles.
Yeah, unicorns are very interesting. We recently mused aloud over whether Uber, which is sort of the largest unicorn of all, could be as much as 90% overvalued. Because when you get to, so for example, Uber recently topped $50 billion in private market valuation. But when you look at where those numbers come from, it's sort of like a magician's trick. Those numbers are based on the sums, very small sums invested. So for example, Microsoft might buy $100 million worth of Uber at a $50 billion valuation on paper. But when you actually look at what their revenues are, they're tiny. And when you actually look at what their profits are, they aren't making anybody yet. So nobody actually really knows how to value companies like Uber and Airbnb. Nobody really knows what the multiple should be, because these companies are still losing money as they try to grow as fast as they can. And so you just have this big pile-in into this small handful of super unicorns leveraged off a zero interest rate environment. So once that goes away and we go back to saying, okay, what's this company actually really worth in terms of its ability to produce cash, you could see the real valuations fall by crazy numbers, by say, 80 to 90%, and with Uber in particular, Uber's value could fall 90%, and it would still be a $5 billion company. It would still be, it'd still be a huge company. So it's really interesting to wonder the psychological effect that would have if people came back down to earth in terms of these valuations.
Yeah, exactly. I mean, do you think we're seeing something similar to the dot-com bubble where they're not exactly sure how these companies are going to be profitable, but they're like, I just need to get a piece of this? Is it similar or is it different this time?
I think it's both similar and different.
Okay.
The dot-com bubble was very indiscriminate in that everyone was simply chasing eyeballs, and there were just a whole lot of companies trading at hundreds of times earnings. Today, we actually have some juggernauts in the tech space that are making a lot of money. I mean, nobody can say that Facebook and
Sure, yeah.
Apple and others are printing cash, but we have this handful of unicorns. There's really only a very small number of Ubers and Airbnbs and whatnot, and so they turn out to be like Picassos. They're overvalued because there's so much institutional money chasing returns and only a small handful. So these companies are going to make money. They are going to be profitable, which means we've matured, at least from the dot-com standpoint. We're not funding new pets.com type things. But that stream of profitability they'll ultimately have may be overvalued right now by something like 10x or 20x. So we've at least learned our lesson a little bit, but we're still well into bubble territory in terms of getting too excited because of so many people piling into a small handful of names.
Another tech stock that got a fairly, I mean, decent isn't that got a large amount of press over the weekend and into this week is Amazon. The New York Times comes out with this long report saying that that their employees seem to be like overworked and underappreciated. I mean, what's been your take on this whole situation? I actually sat down and went through the whole article yesterday and was like, wow.
It was really interesting. I think Amazon is probably the most interesting company in the world right now. For one thing, on the worker case, Amazon is really the one getting hammered. But really, this is sort of a reveal of much of the whole Silicon Valley culture. Is people don't realize that successful tech companies are much closer to the Amazon outlook than not, and that just really makes us uncomfortable in a general sense to imagine that to be a successful white-collar worker in this world, you have to work 60 to 80 hours a week and sort of abandon your family. There's this fear of, really, is that what it takes to succeed in the 21st century economy? And to a certain degree, at a lot of different places, including Apple and some of these unicorns and other places, that's kind of true. And Amazon has sort of been this Rorschach test of half the people who responded to that article have said, that's horrible, they treat their people terribly, who can believe that, and are just indignant. And the other half has said, well, they're kind of killing it and succeeding, and these people are getting paid a lot of money, so what do you want? So it's sort of a psychological test for how we view the 21st century economy. And Amazon as a stock is also very interesting because it was this money-losing e-commerce startup for 20 years that was basically just barely breaking even, and now all of a sudden it's making money hand over fist in cloud services, and the view is sort of switching to maybe Amazon is going to be a cloud service stock with an e-commerce retail business attached to it. So it's completely even flipped around in terms of how people are assessing its profit drivers. So it's just a really, really interesting story right now from a bunch of angles.
Yeah, I know Jeff Bezos and some people who work there are already kind of jumping in on the debate as well. So I guess it'll be interesting to kind of see. I mean, obviously, it doesn't seem like we've seen a lot of investor reaction, but I'm just kind of wondering if this is going to start an overall debate on what really the future of tech holds as far as its employees and what they're able to produce and how they innovate.
Sure. I think ironically that New York Times article was probably good for the stock in the sense that when Wall Street hears that a company is just driving its employees to the wall to get productivity out of them, their reaction is going to be to cheer and clap more so than to be upset. They're going to say, "Yeah, they're leveraging their assets properly, doing that." I definitely think, there's going to be a continued ongoing debate about profits and humanity and things like that, but Wall Street will continue to take the very hard-nosed kind of "what have you done for me lately" view. And another great point about Amazon that someone made, I forget who, was that Amazon is basically like a 20-year-old startup. And part of the reason they can't afford to have really nice perks for their people like, say, Apple or Facebook can is because they still have that image of not making any money yet. So as long as Jeff Bezos has all of Wall Street trained to accept quarterly profit margins that are razor thin, he has to also just hold back his expenses and look like he's in startup mode permanently. So it's part of their strategy for perpetual permanent startup growth valuation.
We're on the line with Jack Litle. He's the Mercenary trader. He's 17 years of experience. Jack, you got an interesting name for your site there, Mercenary Trader. Could you just give us the details of it and how you came up with that name and the meaning?
Sure. Well, our slogan for our site is a community of ruthless profiteers, and we adopted the name Mercenary to illustrate the fact that we have no love for our positions, you might say, or we would argue that be loyal to your friends and love your family, but be sort of mercenary with your trades and your investments. And the concept was just approaching markets and approaching trading and investing with detachment, like you're going to war, and don't fall in love with a stock, don't fall in love with a position, and just take a serious attitude. And so it's a little bit it's sort of an against the grain message, against buy and hold, just being rational and detached, and it's also a little bit of fun. But we think markets are a battle. You go out there and the bulls and bears are battling every day, and we're looking for the biggest and best opportunities, either long or short, and we don't care which side we're fighting on. Like Jesse Livermore in Reminiscences, we just want to. There's no, the right side to be on the market isn't the bull side or the bear side, it's the winning side. And so the mercenary ethos kind of reflects that.
You've been, on the side of a trader as well as a broker. You're an international commodity broker with clients on 5 continents. Just take away from that experience, dealing with, the retail investor or institutional investor. How did that, help you develop your trading style and your trading philosophies?
Sure. Well, I cut my teeth in commodities, which was very helpful before learning to trade equities, because people who trade futures and currencies and commodities and other things just seem to develop a very finely tuned sense of risk management, which you don't always get in the equity space. So I learned my first trades were in futures. My first really big client was a Russian hedge fund who placed all their orders over instant message, and just working with these guys, working with instruments that had a lot of leverage, I learned respect for leverage and respect for how easy it is to blow up a trading account and other things, which was really helpful before learning stocks second. And I found that a lot of people who start with equities, and a lot of these investors, especially in mutual funds and other things, their sense of risk management isn't quite as developed. Like sometimes you'll hear stock traders or investors and they'll say, well, my risk management is picking stocks that won't go down. Whereas when you come from a world of commodities and leverage, you understand that this stuff is like dynamite. You can do great things with it, but you have to know what you're doing and be careful. So that's probably one of the most useful things that came out of my background.
All right, and finally here with your, background in the commodities markets here, looking at, the crude oil, the different commodities, a lot of deflationary pressures out there. I mean, how does the Fed rate, with what we have, the data-dependent information that we have right now, how does the Fed raise interest rates in September?
Well, the Federal Reserve is really focused more on the U.S. economy than anything else. People are saying the Fed needs to worry about the global economy, they need to worry about China and emerging markets. But if you look at the track record of the Fed, their track record has sort of been, that's nice what's happening to those guys. We don't really care. What we care about is the U.S. economy and how much it's strengthening. So when you look at certain data points like the fact that U.S. home builder confidence is hitting new highs, or that wages are heading in the right direction, other things, the Fed is really looking for signs that the U.S. economy is healing, and it's broadly finding those on enough of a level that it may be able to ignore commodities. The other factor is that the Fed feels pressure to start raising interest rates sooner rather than later because they want to have some ammunition when the next downturn finally does come. When we actually do get an economic slowdown in the U.S. again, the Fed wants to have sort of gotten off the zero line so that it has some elbow room to cut. And then there's also political pressure from Washington for them to finally raise a little bit. So there's a number of factors pressuring the Fed that could cause them to say, yeah, commodities are kind of crazy, but we're not going to worry about it. We still need to hike anyway.
Right, and also, I mean, this is going to make the U.S. dollar even stronger, though, don't you think? And there's been a lot of the companies that have been issuing poor earnings because of that. So might not always. Yeah, go ahead.
Absolutely. I think the U.S. dollar trend could actually accelerate. You've already got corporations complaining about U.S. dollar cutting into their earnings. Now you've got U.S. corporations complaining about China's slowdown. And there's a whole bunch of emerging market countries who have literally borrowed trillions worth of U.S. dollar-denominated debt. And so if you sort of see a short squeeze come around, you could see the U.S. dollar, if it goes a little bit supernova, that's going to be really interesting in that it could create a risk-off paradigm that ripples through all global financial markets.
Yeah, we certainly don't want to see that happen. Jack Litle of the Mercenary Trader giving us his outlook on the markets, interest rates, and we really appreciate you coming on, Jack, and we'll have you on again soon.
Sure, always great talking to you guys.